Good morning. My name is Garry Karch. I'm with RM2, and I would like to welcome you to our webinar this morning on financing the employee ownership transaction, the employee ownership trust transaction. What we're going to do this morning is actually dive a little bit deeper into some of the different types of financing that are available if you're looking at potentially financing a sale of a company to an employee ownership trust, or if you're a professional advisor, if you have a client who is looking at this type of a transaction. The presentation itself is going to last no more than 45 minutes, and then we will have time for questions and answers following that. If you look at the GoToWebinar control panel that should be on the right side of your screen, you'll see down there is a section where it says questions, and feel free to submit any kind of questions you have for the presentation, regarding the presentation, and we'll address those after we get through the formal part of the material. And hopefully you'll have some questions. Happy to spend the time on those. If you would like a PDF version of this presentation, excuse me, or our book on employee ownership trust, please send me an email with your contact information. The book itself is a hard copy, so we would have to drop that in the post for you, but we're happy to do that. But we would need a mailing address, and we can certainly send a copy of the slides electronically if you'd like to have those for reference after you're finished. If you are interested in learning more about the EOT, we do have some online resources at www.rm2.co.uk. And you can see some of the past webinars also on our YouTube channel. It's RM2 Partnership rather than just RM2. And this webinar itself will be posted both on our website and on the RM2 Partnership YouTube channel. So with that, just a little bit of my background. I've actually been working on the EOT in the UK for about a year and a half now, and came over here from the U.S. where I had focused on this type of transaction for almost 30 years. So the EOT draws a lot of its inspiration and a lot of its provisions, based upon some of the provisions of the U.S. ESOP, the Employee Stock Ownership Plan. So with that, let's go ahead and get going into the main part of the presentation. So I'd like to start out and just review a little bit some of the provisions and some of the parameters that relate to the employee ownership trust for those of you who may not be as familiar with the structure. So the EOT sale is really an alternative to selling to private equity or to a trade buyer. One of the real benefits of this structure is that if you sell a controlling interest, and controlling interest it has 4 or 5 different parameters, but the primary one is that you have to sell more than 50% of the company's shares to the trust. When you do that, you as a vendor are eligible for full capital gains tax relief in the tax year the sale occurs, and as a result of the new ownership structure, employees are eligible to receive income tax-free bonuses up to £3,600 per year. And the EOT is unique in that it is also the only tax-advantaged share scheme that allows you to use other tax-advantaged share schemes in a company that's owned by another company. And in this case, the company owned by another company is really the company itself that's being sold is then owned by a limited company in the form of the trust. So there's no other ownership structure that would then allow you to sell to the EOT, which is a tax-advantaged plan, and then also, if desired, implement EMI options for key employees, implement a share incentive plan or a SIP if that was the objective. So you can do that with the EOT, so it's a pretty flexible structure. If you've had the opportunity to sit through one of our other webinars called the EOT as a third-party sale alternative, we spend some time in that actually walking through what the proceeds from the different types of sale transactions look like from a vendor's perspective. And when you look at the financing structure, you look at the vendor loans that we'll talk a little bit more about today, you look at the market structure that we put in place on those vendor loans, and you look at the potential for some equity upside through warrants or options for the vendors, the valuation and the after-tax proceeds can be very competitive. So, there's always going to be potentially that opportunity to sell to a trade buyer who's going to pay a very high multiple because they see synergies in the transaction with their own business. But for the most part, the EOT can be a very, very compelling alternative. One of the key factors, though, in making this a realistic alternative is the ability to obtain financing and create some liquidity at completion for the vendors. There's the objective of doing the right thing. Some people would look at that and say, sell to the employees, reward them for their contributions in helping to grow the business and create value for the vendors. But you have to look at this, in our view, from a commercial perspective. If you have the opportunity as a vendor to sell to a third party who's going to pay you a lot of cash at completion and then maybe have you roll some equity into the new company, you've got to balance doing the right thing. And again, I say the right thing in terms of how a lot of people in the employee ownership space look at this, between doing the right thing and then also structuring a commercially sound alternative to a third-party sale. So it really comes down, in our view, to a successful transaction, including some third-party financing and creating some liquidity for the vendors. That's not to say, though, that we haven't had clients who have been happy to take a commercially structured vendor finance transaction as a viable alternative and actually have gone down that road. We've had a number of clients do that because they've looked at the return they can earn by financing the transaction 100% on a deferred basis and said, I'm very comfortable with the company's ability and its cash flow to pay me off over time. So from that perspective, we're talking about, primarily the financing commercially today, but you can still look at something commercially structured only with vendor financing. So that's an important point. So when you look at the overall structure of financings for these types of transactions and for buyouts in general, there are really sort of two types of these, we call them debt tranches. The first of these is what you're probably most commonly familiar with, and that's just senior debt. So that would be provided by banks. There are some third-party non-bank lenders that are in the market now that have actually developed some fairly compelling alternatives to bank financing in terms of structure, in terms of flexibility. You typically will pay more for those, but if your objective is to create the greatest amount of flexibility from a financing structure, possibly get a little bit more cash at completion, they can certainly be a competitive alternative to a bank financing. You also then have subordinated debt, and that's provided generally with smaller SMEs. In a transaction like this, it'll be provided by the vendor. If you're looking at a larger business, there are specialized junior lenders in the market who will provide this subordinated debt. So you've got some flexibility there in terms of greater cash at completion, for a larger business, because there are parties out there, third-party investors who will provide subordinated debt at completion, lets you obtain more cash. The third option is what we call unitranche debt. And it's the structure we'll talk a little bit more about as we go into detail, but it really combines some of the features of bank debt and subordinated debt and really sort of creates a hybrid structure. And we'll walk through some of the pros and cons of that as well. So the rest of the presentation is going to provide you with an overview of each of these tranches, the financing structure, talk about how these loans are underwritten by lenders, and show you what a potential transaction would look like with an EOT transaction. So the overall structure we're going to work with is shown on this page. So we have to make a few assumptions that will carry through the analysis and the summary toward the end. And start out by just defining one of the key terms, and that's EBITDA. So EBITDA is, as you can see on the screen, earnings before interest, taxes, depreciation, and amortization. And it's really a proxy for the operating cash flow of the company pre-tax. So in this particular case, we're going to assume that a company generates EBITDA or operating cash flow of 2 million pounds per year, and that the purchase price multiple for the transaction is going to be 6 times EBITDA. And again, these numbers are for illustrative purposes. Your own situation, your client's situation will certainly differ from these. But if you look at the multiple, what we see in the market right now is that for a typical SME, you're going to see a valuation range probably somewhere between 4 and 6, maybe 6.5 times EBITDA for a very strong, very profitable business. So we're just arbitrarily selecting this 6 times. It's within the market, and then we'll use that as the basis for our valuation in our example. So what we do then in terms of valuing the company is we take the EBITDA number, the operating cash flow, and we multiply that by the purchase price multiple, and that's 6 times EBITDA, and that would be determined based upon looking at comparable transactions in the market. It would be determined based upon comparable listed company trading multiples. So there's a basis for that. It's not just an arbitrarily determined number. But if you multiply EBITDA times that multiple, you get what is called enterprise value, and that's the value of the business if it were debt-free and cash-free. In this particular case, we're going to assume that there's 1 million pounds of existing debt and that there's also 100,000 pounds of excess cash on the balance sheet. So for this particular situation then, we're going to end up with an equity value of 11.1 million pounds. And we get that by subtracting the debt from the enterprise value and then adding the excess cash. So after we've determined the equity value of the business, we then have to look at how we're going to finance the transaction. And in terms of the order of cost of financing, the first place to look really is the company's excess cash. That has the lowest cost to the company and to the vendor, who in effect has to worry about company cash flow to pay them back. So you start with the company excess cash. You would then look at bank financing. You'd then look at the vendor debt, the vendor loan. Potentially could also be a specialized junior lender for larger transactions. As an alternative to the bank debt and the vendor loan, you could look at a tranche or a section of Unitranche Debt. And you can also look at potentially a private equity investor to help fund a portion of the transaction. That universe is somewhat limited because given the requirement that the EOT, the Employee Ownership Trust, have control of the company from a share capital perspective, you need to find private equity investors who are comfortable with non-control investments. There are some out there. There are some that have actually done EOT transactions, but it's not the size of the overall private equity universe that you would expect, because most of those investors are looking to make control investments where they actually have voting control, equity control of the company. So having walked through that then, how do we structure the transaction? So what we're going to do is start with the sources of capital for the transaction and then talk about how that capital is applied or how it's used. So this is called a sources and uses of funds statement. So from a source perspective, we've got 100,000 pounds of excess cash. We're going to assume that we can borrow 2.5 times EBITDA in terms of bank debt. So if you took 2.5 times the 2 million of EBITDA, that gives us our 5 million pounds of bank debt. And then we have to fill that gap between purchase price and the amount of fees and expenses with a vendor loan. So if you look at the sources then, that totals 12.3 million pounds. The way we apply those funds then is going to be to purchase the shares. So we're going to buy 100% of the company's equity for 11.1 million pounds. We need to refinance 1 million pounds of existing debt. There are very few lenders that would not require their debt to be refinanced if they're going to be the non-transaction party still in the capital structure. So we're assuming there's going to be a new lender in this particular case So you've got to factor in the fact that you need to refinance some existing debt, and that reduces the amount of cash available at completion from the cash in the bank loan. And then we're going to assume in this particular case, about 200,000 pounds of transaction expenses. That would be for financial advisors, bank fees, bank attorneys, lawyers, company lawyers, what have you. So the sources and uses equal one another. And when you factor all of those together, what you end up with is illustrative cash proceeds to the vendors from this capital structure of 3.9 million pounds. And the way you get to that number is you take the bank term debt, the bank term loan, you add to that the 100,000 pounds of cash, you subtract off the million pounds of existing debt that needs to be refinanced, and you subtract off the 200,000 pounds of estimated transaction expenses, and that's then going to give you the amount of cash that's available to the vendor at completion. So again, just sort of walking through the cost of capital that we talked a little bit about. You start with the least expensive is the free cash on the balance sheet. You go then to the bank loan, the vendor subordinated loan, and those two are usually looked at in conjunction with one another. Unitranche is an alternative to the bank loan and the vendor subordinated loan combination. And then you have the private equity investment as another alternative. So let's talk first now about the bank debt or the senior debt. So as I mentioned before, this is typically provided by banks. However, there is growth in the number of specialized debt funds that will look at financing transactions for SME companies. And one of the difficulties with the bank market when it comes to financing a transaction, whether it's an EOT, whether it's a management buyout, is that these are typically loans that are made for what are considered non-productive purposes. Productive purposes would be investment in new equipment, a new factory, new plant, funding debtor accounts, that type of thing. So these are looked at as sort of non-productive debt, and they're typically, if there's any kind of existing debt at all, they're typically a cash flow loan because the assets generally are not going to be sufficient enough, given that this is a transaction, to fully collateralize or fully support the amount of debt. So while the lenders will take a charge over the company's assets, and with an EOT they can take a charge over the shares, these are cash flow loans, and you'll typically see a bank looking at a very short repayment schedule. We actually just are completing a transaction now where we had our two finalist lenders. One was a bank, one was a third-party financing company, and the third-party debt fund actually provided a 6-year repayment schedule where the bank started out at 3.5 years and then they moved to 4 years. But there was more funding provided by the specialized lender with a longer repayment schedule. It was more expensive money, but our client thought that was a better alternative for the company and for him personally than the bank schedule. So there is interest in senior debt from a bank perspective in these transactions, but it's typically going to be a loan that provides less funding with a shorter repayment schedule. So as you look then at how these are priced from a bank's perspective, you will often get a floating rate debt proposal based either upon LIBOR, which is the London Interbank Offered Rate. It's a benchmark interest rate used for corporate loans, or the Bank of England base rate, plus some kind of a spread to account for the risk. Typical pricing would be in the range based upon the perceived strength of the business, in the 3.5% to 6% range. So the next piece of the financing puzzle, when you look at sort of a combination rather than the unitranche structure, would be the subordinated loan. So this is most often provided in conjunction with senior debt, with bank debt. And when we say it's junior to the bank with respect to payments and charges, what we mean by that is that the bank will take a first charge over the company's assets, and in effect it's cash flow. and it means that the bank has to get paid first before the subordinated loan provider would get paid. So bank receives its principal and its interest payments, during the year, and then after those payments are made, then the subordinated loan provider would get their interest payment. So that's typically going to be, again, for smaller SMEs, that would be interest on a vendor loan. For larger transactions, it would be interest provided by a third-party subordinated debt provider. And that debt is going to be more expensive because it's riskier capital. It's behind the bank in terms of its claim on cash flow and on assets. So there's a risk-return trade-off there. Greater risk means a higher return to the provider. You generally won't receive any principal repayment on an ongoing basis with junior debt. It's longer term in nature. It's typically going to be repaid only when it's refinanced by the third-party senior lender. So the typical structure would incorporate the bank loan, it gets paid down to a certain level, and then you have the debt capacity to refinance the subordinated debt, whether it's vendor loan, whether it's third-party debt. And that cycle continues until you've paid off the full debt for the transaction. Pricing for subordinated debt is generally fixed rather than floating. All in return that a subordinated lender, and this is the case whether it would be a vendor or whether it would be a third-party debt financing source, is going to be somewhere in the 10 to 12% range. And that's going to be comprised of cash interest, usually up to 8%, and then there would be options or warrants, another term for an option, for a certain percentage of the shares that debt provider can sell back to the company at some point in the future when the debt is largely repaid, to bring their overall return up to that 10 to 12% range. So, the options or the warrants are going to provide an additional return that on a sort of a present value basis would provide the equivalent of a 10 to 12% annual return for the debt provider. And from a repayment schedule, you're typically going to see the subordinated debt actually mature, in most cases, say a year after the bank debt is repaid, just to make sure there's what we call structural subordination as well as formal subordination. The other option that I've mentioned a couple of times is unitranche debt. And unitranche debt, can be used in conjunction. When I say junior to bank debt, it's really a question of what kind of bank debt you have. So from a transaction perspective, you would usually not have any other financing with respect to the transaction. So to the extent that there may be an overdraft facility, that type of a structure, that there could be invoice finance, the unitranche lender would be junior to the bank with respect to those facilities and any collateral that they specifically had taken a charge over. But otherwise, it's a senior debt instrument where if there's no debt for invoice finance or overdraft, this is the debt in the transaction. In a lot of cases, what you'll see is a very long-term stated maturity. So with the unitranche debt, again, the interest-only comment really relates to the context in which it's involved with invoice finance or similar types of bank debt. But usually what you'll see with unitranche debt is maybe a stated 20-year repayment schedule. So 5% of the principal would be repaid every year. And then there would be what we call an excess cash flow sweep, where after you've looked at the obligations of the business with respect to any other debt, with respect to taxes, capital expenditures, cash capital expenditures, there would be a percentage then of that remaining cash flow that's applied to prepay or to repay the unitranche debt. So it's structured flexibly with a much longer term amortization or repayment schedule, but it also, in most cases, gets repaid very similarly to traditional financing structures because you're using that excess cash flow sweep to make the repayment. Typically interest only, again in the context that there's third-party financing there. Pricing is flexible with these. It can be either LIBOR or Bank of England base rate based floating. It can be fixed. The all-in return here is a little bit lower because it tends to have a better security position than the subordinated debt, meaning it's in a priority position with respect to its claim to assets. And again, similar cash interest payment, 7 to 8%, plus what we call potentially PIK interest, which is payment in kind. So that's really interest that's not paid, but it's added to the loan balance. So you get a compound return effect over time, with the interest being added to the principal and then interest being earned on that higher balance. And to the extent necessary, there can also be options or warrants if there's still going to be a gap in terms of the overall return to compensate for the risk. Then our last financing source that we've mentioned is the private equity investor. Again, this is more difficult to source, only in that most private equity firms do look for a control position in the companies they invest in. What you can do, though, is structure these with what we refer to as control by covenant, where the private equity firm is still in a position to protect its investment, where if there is a default under any of the documentation, they'd be able to then control the actions of the company through documented agreements with the company and the trust. This is very expensive money. Again, it's the riskiest money because it's behind everybody else with respect to its ability to get repaid. So generally, a private equity firm is going to be looking for a return somewhere in excess of 20%, and it can go significantly higher than that. The other issue that you deal with respect to the private equity investor is how do they get their money out? While there are some firms that will make an open-ended investment, in most cases, private equity actually wants to be able to realize or get cash for their investment, sell out of it, generally in a 5 to 7 year window. So with this kind of a stake, because it's a minority position, it could be 20%, it could be 25%, whatever it is, they aren't in a position to sell control of the company. So their only buyer, in effect, in most cases, really becomes the EOT, because there's really virtually a non-existent market for small minority interests in privately owned companies. So they have to factor into their return calculations the fact that they are not going to get anything more, generally speaking, from a valuation multiple perspective than what they bought in at. So in our case, if the company was valued at 6 times, they're going to be selling their minority stake at 6 times EBITDA at some point in the future. And that may or may not work from them in terms of what kind of return they've promised their limited partners or the investors in their funds. So going a little bit now into the structure of the bank debt and what you can expect and what we sort of have built in to the analysis you'll see that follows the overview. So again, we're going to be looking at the 2.5 times EBITDA. We're using a 3-month LIBOR plus that range of 3.5 to 6%. A bank is typically going to charge anywhere from 1.5 to 2% as an upfront fee. They'll call it different things. It may be a closing fee, a commitment fee, an arrangement fee, but generally speaking, you will pay that amount up front as the financing is completed. And a lot of cases that can be paid out of loan proceeds, but it still is a cost to the company. Loan term, again, 5 years is going to be probably the most common with respect to a bank. Again, we had one that was a 3.5 and then a 4-year. The non-bank lenders will typically go a little bit longer than that. Repayment schedule can be, in some cases, up to 7 years, although I would count on more realistically a 5-year repayment schedule as being most common, particularly with a bank. And again, they're going to take a first charge on all of the company's assets in return for providing the loan. Structurally, what's different about the senior debt with an EOT transaction is that the loan, because of some tax penalties, the loan is most often made to the trust, and then with a company guarantee and a covenant to make the contributions to the trust necessary to repay the debt. There's it's called an advanced tax payment on loans to participators, for those that may be familiar with it. But it really penalizes the business in that, there's a 32.5% tax that needs to be paid up front if something is perceived to be a loan to a participator. And if you lend the money to the company, which then lends the money to the trust, that can come into play. So it's a pretty onerous penalty. That gets refunded when the loan is repaid, but it still has to be paid up front. So the market has evolved to the point where loans are made to the trust, and then the company guarantees and covenants to make those payments. So when you measure the loan parameters, so from an underwriting parameter perspective, a lender is going to look at really three primary financial covenants. They're going to look at fixed charge coverage, which is also known as a debt service coverage ratio, and that really looks at the company's available cash flow and compares that to the principal and interest requirements of the debt. You look at a senior leverage measure, so that's going to look at the amount of bank debt compared to the amount of EBITDA or operating cash flow. And then you look at total leverage, which is going to look at the combined bank debt and vendor debt or other subordinated loans, and compare that to EBITDA. So those are going to be the three key financial covenants that a lender is going to look at as they underwrite a transaction. From a bank perspective, they're going to be concerned with the first two, the debt service coverage or fixed charge coverage ratio and the senior leverage. Total leverage is less of an issue to them because the vendor loan or the third-party subordinated debt is going to be subordinated to them, as the name would indicate, meaning that it doesn't have a lot of rights from a creditor perspective, particularly if it's a vendor loan. Either way, sort of the first adjustment or the first, call it the first step, if there's a problem with the company's performance and its ability to service its debt, it's going to be to shut off the interest payments on the junior debt. So that will be one of the provisions built into the loan documentation, that if the company is going to violate a covenant, the bank has the right to require those junior debt payments be accrued and not paid in cash, which then frees up more cash to service the bank debt. There will also be some non-financial covenants that will be part of any credit package, and again, sort of common sense type items, but timely financial reporting. So the lender is going to want to see, how the company is doing on a regular basis. Reports can be required monthly or quarterly. There will be a requirement for the annual accounts as well. There will be a periodic covenant compliance certification often required. That's typically done on a quarterly basis. And in some cases, there may be a request or requirement for an annual budget. There may be capital expenditure limits, all common sense things that just help the lender make sure that the company is performing as expected. And if it's not, that it gets sort of an early look at that and can take steps in conjunction with management to make sure that the bank debt continues to get repaid. Typically what will happen if there's a violation of call it a technical violation, which is a violation of one of these covenants, and not a payment default, which is actually missing or not being able to make your principal and interest payments. Typically with a technical default, you'll see a possible restructure of the debt, maybe extending the repayment schedule somewhat, and then a waiver of the covenant violation would be the typical outcome. Payment default's another story, and then at that point, the bank or the lender is going to be looking at alternatives that, if it looks like it's not curable, could include placing the company into administration. But that if the deal is structured properly up front and not overly leveraged, doesn't have too much debt, you can help minimize the risk of that happening. And then the last item is just, the vendor notes or the subordinated debt are going to have to be structured and subordinated in a way that's acceptable to the bank. Again, common sense, if you're the bank, you want to make sure that your rights are superior to those of the junior lender. So from a subordinated debt perspective then, what you would often see is credit facilities combined with the senior debt of maybe up to 3.5 times EBITDA. We talked a little bit about the interest rate, so that's really what we call it. We refer to it as a turn. So that's another turn of EBITDA above and beyond the typical maximum you'd see from a senior bank lender. Interest rate, talked about 7 to 8%. Here we've got 7%. With warrants and all in return, that gets you into that 10 to 12% range, which is a market return for this type of debt. The closing fees are typically higher on junior debt or subordinated debt than they are on senior debt. So you've got 2 to 3%. And the maturity, again, will be structurally subordinated to the bank debt, meaning it matures after the bank debt does. So a 1-year maturity provision is common, although, as I mentioned earlier, in most cases you won't get to the maturity here because that debt will be refinanced early as the company has paid down the first drawdown of senior debt. Repayment schedule, typically none. Repaid by financing with the senior debt. Very rarely, and this will typically happen, with maybe a larger business, a lender might permit some repayment out of excess cash flow, but that's extremely uncommon. From a collateral perspective, there's a possible second charge with the consent of the senior lender. In most cases, it's going to be so subordinated that all it really does is put the junior lender ahead of trade creditors. That's really the objective, because if there is a problem where the senior lender has to realize its charge, enforce its charge, then there's probably not going to be a lot left over after the bank debt's repaid anyway. So the key document from the subordinated and senior lender's perspective is really the subordination or the intercreditor agreement. And that's what spells out the rights that each lender has with respect to company cash flow, what happens if there is a default, in what order everybody gets repaid. There can potentially be a three-way intercreditor, because if the senior debt and the subordinated debt from a third party don't fully fund the transaction, then you would still have a deeply, deeply subordinated vendor loan as part of that transaction. And again, the vendor loan would have to be included in this subordination agreement. The financial covenants are the same, generally speaking, but they're going to be set at a looser level than the bank covenants, because the bank is never going to allow the subordinated lender to actually drive the credit. So they'll be there as an early trigger. They'll be there to put a stop on interest payments on the subordinated debt if cash flow isn't what was expected initially. But again, same types of measurements, just structured at a more loose level. The non-financial requirements are going to be identical to what you see with the senior debt. So from a unitranche debt perspective, we sort of talked about the fact that it's provided by non-bank lenders, or can be provided if you're looking at a 100% vendor finance transaction. You can structure a vendor finance deal with, in effect, a senior piece and a subordinated piece. So it's really a question of looking at returns, what makes sense from the vendor's perspective, if you're trying to figure out the best way to put together a commercial structure on a 100% vendor finance deal. The third-party lenders who provide this type of debt, are typically only going to be looking at lending to larger businesses. The example we're using here with 2 million pounds of EBITDA is probably at the very, very low end of where a third-party lender would look for this type of a transaction. So if we walk through, the potential terms of what this transaction structure looks like, you're going to see that it's very similar in a lot of ways to the subordinated debt. Again, the maximum leverage is pretty identical. The all-in return is a little bit lower in this case, 8 to 10% versus the 10 to 12% for the subordinated lender, because as a unitranche lender, you're taking the place of both the senior debt and the junior debt. So from that perspective, you're in a little bit stronger position than just a subordinated lender would be. Still longer term in nature. It doesn't mature as fast and get repaid quite as quickly as the bank debt. So you still get a premium return, just not quite the return you'd get if you were just purely a subordinated lender. That overall return can be a combination of the cash interest payments and then 1 to 2% of that PIK interest we talked about before, which is interest that accrues and then in effect becomes almost part of the principal balance, in that you continue to earn interest on that higher balance or accrued interest. If the PIK or accrued interest doesn't get you to that 8 to 10% all-in return, there can be a small warrant or option position as well. Closing fee is going to be very similar to subordinated debt, often 2 to 3%. Loan term, 5 to 7 years would be pretty typical. Repayment schedule, I touched on earlier, in that you might have a requirement for a 5% annual repayment. There may even be a payment holiday in the first year, but the principal then gets repaid out of excess cash flow. So it would be common to see, that 5% repayment, and then, a requirement that 50 to 60% of excess cash flow goes to pay down the principal balance. And the reason that percentage is variable is, one, it's negotiable, just like most loan terms. But then also, what the lender wants to do is make sure that it's not going to starve the company from a working capital perspective. So that'll all be modeled out as you look at putting together a unitranche facility. Collateral, again, you're taking a first charge here because you're taking the place of the senior and junior lender. The unitranche lender might actually allow a working capital lender, so an overdraft facility with a carve-out of some of the debtor and stock collateral for that lender. Again, financial covenants, it's really fixed charge coverage, but in this case, you only have a total leverage covenant because there's one lender. So there's no senior, no junior, it's just one lender. And the other financial covenants are the same. So now let's take a look at an actual transaction here. And you can sort of see what this looks like. And again, it's based on the parameters we talked about earlier, the sources and uses, the EBITDA. And what we've done is actually run out projections over a period of time and sort of said, okay, here's what the credit parameters would look like, and is this a deal that could get financed? So we start out looking at the EBITDA and then adjusting that down to free cash flow to see what's really there after you've paid what amount to required payments. So you have EBITDA less cash taxes in each year, less cash capital expenditures. And then as we go down through the covenants, and these are the values at the end of each year. So at the end of the first year, you would have 11.5, just under 11.5 million pounds of total debt outstanding, and that's a combination of the senior debt and then the junior debt. So the first measurement of total leverage would be 5.74 times, which is probably, if it's third-party debt, possibly a little high. If it's senior debt with vendor loan, then that would probably be more acceptable. Again, the real key to the third-party lender is going to be that second measure. It's the senior debt to EBITDA ratio. So if you look at that, we started, if you recall, at 2.5 times cash flow is the amount of senior debt that we were able to borrow. At the end of the first year, we've brought that down to 2.14 times. We then, in the second year, bring that down further to 1.7 times cash flow. And in the third year, where I have the red circle, you can see we're down at 1.3 times. And that ratio benefits, it gets lower for two reasons. One, you've paid down debt, and then two, if you look up at the top, you can see that we've made an assumption that EBITDA will grow over time, so you get the benefit of that higher EBITDA as well in determining what the multiple of debt is. So the reason I have the number in 2018 to 2019 circled is at the end of that period, you're in a position where you're down to 1.3 times senior debt at the end of that year, where you could then look at a potential refinancing of the vendor loan. So as you can see, as we go through the rest of the senior debt paydown in 2019 to 2020, our leverage ratio is below 1 times cash flow, and it continues to drop till the debt's completely repaid. So at some point around 1 times operating cash flow, senior debt, that's the point at which you would look to refinance some of the junior debt, and that's the point where the bank would realistically be willing to entertain that. If you look down then at the second part of the analysis, the covenant calculations, are fixed charges, you basically will see that we start out with total fixed charges of 1.06 times. That's tight, and that's factoring in interest on the subordinated debt. So generally speaking, you're going to want to see a number that's somewhere in the range of the 1.15 times or greater that you see in the second year there. So what that would tell you is that in the first year, the bank lender might require that there be some accrued interest rather than cash interest paid on the junior debt. From a bank perspective or a senior lender perspective, if you look at the fixed charge coverage or the debt service coverage ratios down below, those are real strong numbers. So if you're looking at 1.63 times, that means you have cash flow equal to 1.63 times the amount of debt service. That's very strong. So usually 1.25 to 1.35 would be a typical covenant there, and those numbers just get higher and higher, stronger and stronger as you go forward, because as you're paying down debt, you're reducing your interest expense. You also have the increase in EBITDA that we talked about earlier, so you get that compounding effect as well in terms of cash flow generation. And I know this is a lot that I'm sort of putting out here today, so feel free to reach out with any questions following this, or during the using the Q&A screen there on the control panel. Just want to touch for a minute, and then we'll wrap up with the formal part of the presentation here on a couple of points with respect to the interaction between vendor loans and bank debt. And vendor loan can be subordinated debt from a third party as well. So the bank debt is always going to have priority with respect to its claim on cash flow. So that third-party senior lender always gets paid ahead of any kind of junior debt, whether it's vendor or whether it's third-party. The bank is going to be the entity that drives the terms of the subordination agreement. It's in the strong position because realistically, if you don't agree to the terms of the intercreditor agreement, there's not going to be a loan. So that sort of follows through to that third point, that if there are problems, the bank is going to be in the driver's seat in terms of how those problems are resolved. It will negotiate, it will factor in the views of particularly a third-party junior lender, but at the end of the day, it's going to make a decision in its best interest. In most cases, banks are only going to allow interest payments on the vendor loans, the junior debt. Can't stress that enough. It's really important to understand going into a transaction what cash flow is available to whom. And in a lot of cases, we sort of have to walk through initially with a client that you're going to get some cash up front at completion because the bank is going to step up and provide a loan, but in return you're going to have to wait to get the rest of your money out until you've paid down the bank debt. Next point down there, just in terms of risk return, something we've all heard throughout our careers, there is a risk return relationship. So a riskier investment, which is what the vendor loan or subordinated debt is going to mandate a higher return, and you can get there with either interest rate or potentially equity upside in the form of warrants or options. And this last point is we think really key, because in a lot of cases, particularly with employee ownership trust, there's been this historical structure of call it a philanthropic loan structure, where a vendor may have sold to the employees in terms of just pay me when you have the cash to do that. We think that it's important to put more structure behind even a vendor loan, because one of the things to keep in mind is that a trustee has to always act in the best interest of the employee beneficiaries. And let's say you had a friendly vendor loan with either no interest or interest at 2 or 3%. At some point, if the vendor wanted to refinance a portion of that, you're going to need the trust's approval to do that. And if right now the trust is making payments with no interest, and the vendor is saying, I'd like to get more of my money out now, and I've sourced this loan at 5 or 6% interest, the trustee would look at that and say, I'm not sure how I can accept that proposition, because it's not in the interest of the beneficiaries of the trust to now start paying more to repay that debt. So it creates a little bit of a quandary if you have a very friendly philanthropic loan structure in terms of getting any more cash out more quickly from a vendor perspective. If you structure it commercially, where you have an interest rate that's market, you have a repayment schedule that's market rate and market terms, at that point, the trustee can look at it and say, okay, I'm just trading basically one piece of debt that looks a lot like this piece of debt for third-party capital. Much easier for the trust to say yes to that. And at the end of the day, the vendor can always waive interest payments. If they really do want to put together a friendly transaction for the employee ownership trust and the employee beneficiaries, there's nothing that says they can't waive those interest payments. So you can get to the same point while still preserving the ability to refinance that debt more easily than if you had a purely philanthropic debt structure. So that's it for the formal part of the presentation. My apologies for running about 5 minutes over. I do apologize for that, but I appreciate your time this morning. You'll receive a follow-up survey. We'd appreciate it if you would take a few minutes to provide us with your feedback. We do read them. We actually do make adjustments to the content and the format of the webinars based on the feedback we receive. So again, that would be very helpful and greatly appreciated. And if you do, again, want a copy of the presentation or our Intro to EOT book, please feel free to send me your contact information, and we'll be happy to drop that in the post for you. So let me just look and see if we have any questions up here. Yep, just have a request for a copy of the slides. So only see that one request. Okay. So if you do have any questions, anything you'd like to talk about, offline that's more specific to your situation, or to, again, if you're an advisor to your client situation, feel free to send me an email. You can give me a call on the office number down below there. Feel free to call me on my mobile at any time. And again, I appreciate your time and attention this morning. Thank you very much for your participation, and hope you found the presentation useful. Thanks.